Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with another edition of the Weekly Economic Review, this time for the week ending November 26th. So we had a very busy week and a very sour news coming on Friday morning about a new variant. So let's get started with the presentation right now. All right, so by popular demand, I'm bringing back this slide about the weekly action in the markets. So after 4 days, negative for bonds, positive for the TSX and the S&P 500, negative for technology, so NASDAQ. Europe, emerging markets were down, but this is at the close on Friday and as I'm on Thursday, and as I'm recording this on Friday morning prior to market open in North America, well, everything is looking very dire because of the new variant. So bonds are rallying enough to bring these numbers to positive. It's still too early to tell. Markets aren't open yet, and in stock markets, everything is really negative. A sharp sell-off in Europe, about 3% just overnight. So expect some more negative returns there. So the reason here is this thing here. A new variant has been found in South Africa, Botswana, and Hong Kong, and this morning, they announced that they found the first case in Belgium. So one thing that we've learned from the Delta variant is that we cannot seem to stop the spreading of a new dominant variant. So it's very worrisome. And here's an article from The Guardian. The question, how does it compare to other variants? Well, senior scientists describe the B11529, or the new NU variant, as the worst variant they'd seen since the start of the pandemic. And I am no doctor, but the protein that is being targeted by the vaccine is the one that has 32 mutations in it. So there's some doubt about if the vaccines are still or will still be effective against that. So very serious news here. So why is it that serious? Well, here is the Global Fund Manager Survey, a survey of institutional investors. We answer to that survey, and it's about the biggest tail risks out there in the markets. So the first one is inflation, central bank rate hikes, China, asset bubbles, and then all the way number 5 was COVID-19 with 5%. So it seemed that the market had depriced most of the risks about COVID, so it was blindsided by this thing. So that's what it means. So COVID comes pretty much back in line. So a few things that are important. As I said, we've learned from the Delta variant situation that we can't stop the spreading. So we're seeing already some closures of, well, travel restrictions to Europe. But what we've learned very recently is that Europe is not shying away from going into lockdowns again. So we have this. So there will be an economic impact coming from that because we will be in lockdowns probably in Europe if it starts to spread. The COVID zero policy in China is the main risk for the global economy because China is already very strict about its policy, meaning that if there's one case in a factory, they will be closing this factory. There was one case from a tourist traveling to Disney in Shanghai. They closed the park for a few days to get everyone tested. So the strains on the supply chain that we already see right now are probably going to be exacerbated. So closures of ports, closures of factories, closures of parts of China, of regions, of cities, that's going to be putting some more weight on an already stretched supply chain. So if I go back down this list here, the inflation pressure that we're already seeing, probably they will be made worse because the stretches on supply chain will be getting worse. So inflation could be more of a concern. Central banks, what are they to do? Well, there's a few very important dates. December 15, December 16. This is when the Fed meets and decides on December 15. And on December 16, you have the ECB, you have the Bank of England, you have other central banks. So what will they see? Probably they won't have seen enough to do something when we're there. Very likely, this is my expectations. So what will the market think is now the new thinking of central banks? How will it expect the next steps for volatility, for monetary policies, for the support from central banks to the markets? So that's very, very up in the air. So China now becomes, I think, the biggest risk because of how it reacts to this. So it's not about what the virus does. It's about how authorities react to it. To this. In North America, especially in the US, I think the bar is high for new lockdowns, for new restrictions. It's not something that they would be, I think, willing to go deep into, but it's a risk. It's a risk we need to consider. And the asset bubbles risk that we see there, well, the S&P 500, for example, the earnings growth for the next 12 months, so the profits of businesses on the S&P 500 was already priced at 23% growth. So that's very, very aggressive. And the price earnings ratio, so the valuation of the market, was a bit below the recent peak, but still the highest that we've seen prior to the recent peak was the dot-com bubble of 2000. So the market is expensive. The volatility, the implied volatility, or the fear index, the VIX index, was near pandemic lows before this hit. So you kind of have an environment where volatility can easily creep in. So very important development. So in our funds, we sold off some stocks this morning prior to the market open using futures. We completely de-hedged our portfolios because the Canadian dollar acts as a good buffer for when volatility hits. So we sold that off, and we're also looking on adding fixed income. So these are the things that we're looking at. So we are taking this seriously, and we're already acting in the portfolios to remove some risks. So as I was preparing this review on Thursday, I was not planning to talk about this, but this just happened today. So this makes this review a bit pessimistic, I say, because I was planning to talk about this risk here. Bank of Canada worried about the increase in household debt. So on the left from the Globe and Mail, Mr. Paul Baudry, Deputy Governor at the Bank of Canada, saying that by the end of 2021, the share of highly indebted households will likely have more than reversed its initial improvement and topped its 2019 peak. And it also said that investors buying has doubled since the start of the pandemic. So they're seeing some risks here. So they're not expecting anything imminent that's going to be bad, but it's just that it's a background that is that is a big risk in the market. So on the right on the chart, you have the year-over-year change in billions of dollars in credit. So the red line is a non-mortgage loan. So as you can see, people have been cleaning up their balance sheet, and we're not really borrowing as much as before. So there was even a contraction in that, and now it's a small growth, but it's not where there's some issues. So credit use for anything else than mortgages, not an issue. But the gray line is the mortgage. Mortgage loans, I mean, have been jumping. No, the blue line, sorry, the blue line is the mortgage loans. So this has exploded there recently, and this is causing some problems, especially because the share of highly indebted in households, as mentioned, is growing. So those that have a lot of debt have added some more, and the average credit score, the credit quality of the borrowers has also been going down during this episode. So very worrying backdrop here. And this chart here from the Bank of Canada. So the increase of real estate investors. So this is the year-over-year growth in the number of new mortgages by type of home buyer percent, and look at the green line. This is investors. So the number of investors in the market has doubled, and this is especially true in the Toronto market and also the Vancouver market. So a very important factor here. So that has the Bank of Canada worried right now. So if we go to the financial markets, Mr. Powell, I just love this picture. I have nothing against Mr. Powell. I just think it's a funny picture. Mr. Powell has been nominated for another mandate as a Fed chair, so continuity. And Mrs. Brainerd, Lil Brainerd, that was also considered for the job, has been named vice chair. So there were two of the architects of the monetary policy. So lots of continuity there. So that's a good thing for the markets. Now, if you look forward, well, the Fed seems to be in a hurry to taper, and that's probably a good thing because of financial conditions, which I will be showing in a second. But on the left, you have some news clips here. Fed may discuss taper pace at December meetings, as Mr. Clarida, the current vice chair, who's going to be leading in December. So the Fed is still printing money to buy bonds to support the economy, and we don't really need that anymore. So they should accelerate on that. Mr. Waller said that probably the taper should be finished by April. That's his opinion, and I would agree with that. Accelerating the taper is a good idea. And Mr. Bullard saying that we should tack in a more hawkish direction. So it's time to accelerate. So you see the choir of the Fed starting to be pretty vocal on that. On the right side, you have the implied Fed fund rate, the change from current levels. So every time you cross one of those lines, 25, 50, 75, that's one more rate hike that is implied expected by market participants. This is what the market sees, not what the Fed says. So the market is anticipating one hike towards the summer, another one by late 2022, and then after that, pretty much every 3 months have a hike all the way to 2024. So our opinion, my personal opinion, is that we should see one rate hike. This is the base case. We could see two, but I mean, the base case is one towards the end of 2022. After that, in 2023, probably an acceleration of the pace between 2 and 4 per year, depending on how the economy goes. But I think it's a bit aggressive to price in one next summer. I think probably it's going to be further down the road. But still, the Fed is in a hurry to start acting, especially on its tapering of the quantitative easing, because financial conditions have never been more accommodative. So this is the Goldman Sachs index. They look at the price, the stock market, bond market, all of the risk sentiment indicators, other risk measures out there, how easy it is to get credit. So many things, the spreads, the level of interest rates, pull all that into an index, and as you can see, when it's low, that means that the financial conditions are easy, and they've never been this easy ever. So there is no necessity to be printing and printing and printing some more. So I think the Fed is seeing that, and it will be acting whatever happens. But the new COVID variant that we have here, it's a very big potential game changer. So let's see if that changes things. So ia.ca/economy, your go-to webpage, Economy and Finance 101 section. We added some new stuff recently. What's a stock, what's a bond, and emerging countries and emerging markets. So go there if you want to learn about this. Twitter and LinkedIn are two ways to follow us too. And you can find a PDF version of this presentation on LinkedIn. I will be posting it right away. So on Friday morning, post it when I'm done recording, so you can have access to that. Just connect with me and you'll find it. So thank you everyone for following us on a weekly basis, and I'll see you again next week.